Have you just sold a property and made capital gains from that particular investment? Or if you've just sold a house and you're sitting with good capital gains, which are going to be taxed at the 20% rate? Or if you've sold equity shares in the market and you're sitting with long-term capital gains and you're wondering whether investing those capital gains into capital gain bonds to save taxes is a good idea or not? Well, let me help you understand this then. Hi, my name is Harshvardhan Dawar and I am from Wealth Cafe, where we share with you ideas to help you make smart investing decisions. If you are somebody who's sitting with capital gains from sale of a capital asset, long-term capital gains, then one of the avenues available for you, if you are not looking to buy a house because you already own a house, then the next best option which is there for you is to invest the money in a capital gains bond. Now, what exactly is a capital gain bond? A capital gain bond is something which is issued by one of the government entities, be it REC, PFC or IRFC. And these bonds allow you to park your money in them and claim an exemption to the extent of the amount you've invested in these capital gain bond. Today, the limit is an amount of 50 lakhs. So a maximum of 50 lakhs can be invested in these bonds to claim an exemption from tax, which is still a good amount. Now, when you put your money in a capital gain bond, there are two things we must look at. One is they are locked in for a period of 5 years, and the return that you will get today is at a return of about 5% for investing in these capital gain bonds. And the returns, that is the interest that you earn, is not tax free. The interest is taxable. What is going to be tax free for you is the capital gains that you earned, which you are investing in these capital gain bonds. Those long-term capital gains become exempt, and that is where you save money. But the 5% that you earn from investing in these capital gain bonds, they are definitely going to be taxable, and your money is going to be locked in for a period of 5 years. Well, with this information, the next question is, should you invest in capital gains bonds to reduce your tax bill today? Well, for this you need to go back and look at what is the return that you get as an investor. So if you are somebody who is going to use the capital gains that you earned and put the money into a debt investment, into a deposit, right, you are definitely going to earn a higher return. If you look at the 5-year deposit rates today, they are in the range of 7%, right? You're definitely going to earn a higher amount. But if you were to put the money in a deposit, first you will have to pay off taxes on those capital gains and then put the money in the deposit, right? So if you earned a return of 100 rupees, you will have to first pay off capital gains of 20, you're left with 80, and that 80 can be invested into a deposit. When you put a money of 80 rupees into a deposit earning 7%, over a 5-year period, you are not going to make as much as you would make if you had put the entire 100 rupees into the capital gains bond, which are going to earn you 5%. The return is lower, but the amount of capital being invested is higher. You are going to be investing the entire corpus of 100 versus putting the corpus of only 80. So at the end of a 5-year tenure, you are better off putting the money in a capital gain bond. Having said that, if you are somebody who is going to use the capital gains, put the money in a more aggressive portfolio, maybe a mix of debt and equity, maybe equity completely, maybe use that to buy some real estate, and you expect to earn 12, 14 or anything higher there, then you would be better off by paying off your taxes today, discharging the long-term capital gain taxes. So your corpus of 100 becomes 80, taking that 80 rupees, putting into the mix of equity and real estate that you've looked at. And if you're able to make a return of anything about 10% on that portfolio consistently for the next 5 years, then you will be better off. You'll land up with a corpus which is higher than investing 100 rupees at a 5% rate for the 5-year period. Well, this comparison is just to help you make a decision. What you must know as an investor, that when you are investing money in equity and real estate, there is going to be some amount of variability, whereas here it's going to be a fixed return. But that's what you do as an investor, right? When you put investments and take a risk, you're taking the risk to earn higher returns. So when you are looking at capital gains, you need to decide between whether capital gain bonds are good for you or not good for you. You decide based on what you're going to do with that money, right? If you're going to go and put the money in a fixed deposit, it doesn't make sense doing that. As well, put the money into capital gains bond, you will be better off. If you're going to take the money and actually get aggressive with your investment, you expect to earn anything upward of 10%, then the capital gains that you would have paid off, the tax that you would have paid off, it will be recouped because of the higher returns, and you will be better off at the end of 5 years with a portfolio of equity and real estate, which is giving you a higher return. I hope this has helped you understand whether capital gain bonds are something that is good for you or not. If you have any questions, do leave them in the comment section below, and do like, subscribe to our channel so that you continue to get such fantastic ideas every Wednesday and Saturday of the week.